Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Hello, and thank you for tuning in to another episode of No More, Risk Better. I'm your host, Zach Griffiths, head of U.S. investment grade and macro strategy at CreditSights. And today we're going to be talking all things chems, one of the most notable and craziest spaces in the IG and leverage finance markets. So this is going to be a great discussion with three guests from within the organization. We're going to be talking with Andrew Brady, the head of U.S. Basics, Andy Belton, our head of Euro Basics, and Peter Agra, the managing editor for secondary markets at LFI. Thank you three for coming on the podcast. When we were starting to plan for this podcast, the big news was the downgrades in the chem space that happened on February 18th. That feels like about a year ago with all that's happened since then with the war in Iran and all of the various developments in global energy markets. So I guess to zoom out, let's just kind of get a sense of where we are on the space. Andrew Brady, I want to start with you. Kind of how does the rapidly evolving situation fit into your views of the broader sector? I know you've made some ratings adjustments. Maybe we can start with petrochems and kind of go through the space starting there.
Yeah, I think to your point about things rapidly evolving, things have changed, dramatically since we're playing this out, last week and putting it all together. The war in Iran started and the oil prices spiked. And I think that you have that and you have the rating agencies coming in and bringing down a bunch of names in the sector. So you had a lot of negative news and the drop in oil prices. What that did was that caused a couple of things. It caused a mismatch between feedstock costs. So it made the U.S. players much more advantaged. And then also a lot of supply is trapped, or production is trapped. Storage is full. They can't put it anywhere. So now you have a sudden tightening or artificial tightening of the supply demand picture. So basically, the longer it goes, the more you have production offline, which makes you wonder: is this maybe a spark that could get things really kind of moving in the right direction, or is this like a short term blip? Where almost like a false start. So we did, we put Dow to outperform, we put Lidl to outperform, we moved Methanex to outperform. These are all players that benefit from the mismatch in crude oil prices and natural gas prices. So I think that's like a good place to start. And then, we're going to have to go through it and kind of go through each name and see with that, what happens to, each individual company. We'll start that analysis, in short order.
In terms of those upgrades, is it all on the back of the relative input cost difference in terms of natural gas in the U.S. relative to what you're seeing in Europe and Asia, or are there any other nuances that you're focused on? I know looking at the ISM manufacturing, we had that briefly jump into positive territory in January. I think that's one of only a couple readings in positive territory over the past 3 years. What other macro factors are at play that you have your eye on?
Yeah, I think that's a really good point. I think we were talking earlier about performance and that the chem sector is doing well. I would say well, but they're not underperforming, which in our space is pretty good. And I think a lot of clients are buying on the back of there's been the ISM has been positive. There has been some rumblings of some improving demand. It's also been like the it's been underwater for 3 years. There's been no demand, and it's like, okay, can it go 4? So you have a lot of people being like, that would be even more odd if it were to continue. So they're buying on a little bit of hope there. I think what we're trying to do is we see some of the things that are percolating around that has demand. It still is, at the seasonally weak period, so it's hard to think about like how to weight that. And then, we're really trying to listen very, very keenly to what companies are saying. And companies are saying, we're not really seeing anything right now. We're not seeing that demand. And I think that kind of dovetails into the seasonality aspect of it. So you're getting a little bit of that dichotomy between what companies are saying, what you're kind of seeing in some of the manufacturing stuff. There's also some mixed factors within that, as I know you're aware of, Zach. And then, trying to compare the two and kind of go from there. And then when we think about the big macro one would be, for these oil prices, if they were to stay this high, well, what does that mean for demand? What does that mean for the end market? So the longer you go, you're kind of getting, okay, you're taking supply offline and you're create this artificial, tightening. But at the same time, how much the end markets are destroying when it frees up, and how do you weigh all those factors?
Yeah, there's certainly a lot of moving pieces. I think you make a great point. There's considerable uncertainty about how long the conflict remains in place, how long the strait is closed. You even have oil prices coming down very significantly from their recent peaks just on the idea that the conflict could be near an end. And I think we're in for some volatility to continue in the near term. And so that certainly makes for a difficult operating environment for these various companies within chems and really across the economy. So, Andy, I want to bring you in to get your perspective from Europe. One of the big factors at play there that could be viewed as more of a tailwind to the basics as a whole and chems is the $500 billion German infrastructure spending package. Do you view that as a huge tailwind, or is it more at the margin when you consider all these various other factors at play in the market today?
Yeah, I think the short answer, Zach, is that it is not a panacea, and it's clearly a positive both for Germany and for infrastructure, for Europe in terms of macro. But I think I'd be lying if I said, look, that the German infrastructure program is the epitome of the white knight charging over the hill to save the European chemicals damsel in distress. I think the problems that we have over here are much more deep rooted, to be honest. Just to talking about the infrastructure program, just remember that this is effectively back-end loaded. It's a 12-year program. So it's a long-term initiative. It's not a short-term fix or not a short-term cure. Secondly, the infrastructure only accounts for about 20% of total German construction spending. It's dwarfed essentially by residential, which is about 56% of total construction value, and non-residential, which is 24%. And actually, that's a similar case if we look across Europe as a whole, where infrastructure is about 23% of total construction, residential is about 47%, just under half, and about a third, 30% is non-residential. Now, thirdly, there is the fact that both residential and non-residential are much more chemicals intensive in demand terms than infrastructure. Infrastructure is very intensive on products like cement and concrete, but doesn't have that same kind of fillip for chemicals. Now, as it happens, European residential construction is expected to recover slightly in 26, around about 2% growth in activity in real terms. And this is after 3 years of solid decline. And we're going to see a similar kind of cadence in non-residential, about 2% this year, after, again, a couple of years of real problems. But weak demand is only one of a number of problems that the European chemical space, and I'm talking chems obviously in particular here, has been wrestling with in the last few years.
So I know in the US, we like to try to paint the Eurozone, European Union, whatever subset of European countries you want to group together as one broad brushstroke, what's going on in Europe. And that's obviously very difficult, impossible to do with all the different economies and the different underlying trends and structural factors at play there. So can you talk about some of the key factors, such as the impact of energy costs, which has only become more important, tariffs, and how that's driving regional dispersion and how that fits into your thinking for the European chem space?
Yeah, sure, Zach. And actually, your question does feed into the comment that I just made at the tail end of my first answer, which is what are these three major headwinds that European chems, particularly on the petrochemical value chains, has been buffeted with in the past few years? Firstly, we've seen persistent weakness in demand. And that's partly because, as I just mentioned, we've had a construction sector that's been weak for 2.5 to 3 years in Europe. Interestingly, the US seems to be, Europe is slowly improving and the US is going the opposite way. We've also seen weakness in automotive, and both automotive and construction are very important end-use markets for a number of the different chemicals value chains. Secondly, I think what we have seen is what a number of chemicals investors have been arguing, which is essentially structural oversupply, not cyclical downturn, but actually structural oversupply. And that's pretty much across European chems as a whole. We've seen a raft of imports flooding into the European market, partly because from three main sources. The first, of course, is China, and that's partly because of a strategic push by the government to establish a strong export market, but also as a result of displaced supply that was previously bound for the US and obviously has been displaced by tariffs. Secondly, of course, we've seen quite significant imports in certain chems value chains from the Middle East. That situation is obviously fast changing by the day. And the third one is, of course, in the US itself, where the US actually has a structural cost advantage, and there have been some exports coming across from the US into Europe in certain parts of the chems value chains. So just to give you a kind of data point, in PVC, despite a raft of announced capacity closures, Western European capacity in PVC remains structurally excessive. And I've seen estimates that something like 800,000 tons of capacity is needed to be taken out of the market in order to restore operating rates to anything like economically sustainable levels by the back end of 27. So we do have real structural problems in Europe. And thirdly, of course, that European petrochems continues to face persistently high energy costs, particularly when viewed against the lens from the US or other global peers. And if we think about US capacity, of course, it benefits from structurally from a cost advantage from shale gas and a strong feedstock advantage in ethane. And that's partly, so this sort of structural cost disadvantage for Europe, it's partly due to persistent high energy prices. They have come down since the heights of 2022. I'm talking about before, obviously, 9 days ago. They had come down since the Russian-Ukraine war, but they're still persistently high. And the second, of course, is the fact that we have significant higher carbon taxes in Europe versus the US. So that obviously has exemplified quite a significant natural gas cost disadvantage for Europe versus the US. And this structural disadvantage has forced significant closures across the European chemicals capacity. For example, I've seen estimates of about the closure of about 15 to 25% of European chemicals capacity in chains like PVC. So this oversupply situation is not going to resolve without significant either restructuring of the European energy market or some change in US natural gas prices. And of course, now added on to that, we have the situation in the Middle East, which is obviously completely changed the game. The escalation in oil and gas prices, notwithstanding the drop we've seen today, is only going to make things worse, particularly for those European chems names that are more reliant upon gas or naphtha as opposed to ethane.
Do you have a few of those names handy, Andy, that we could, highlight in terms of, where you see kind of the greatest risk from a single name perspective?
Yeah, and of course, no one would be surprised if I start mentioning the word INEOS. But of course, we have to be careful which silo we're talking about. So INEOS Quattro is the much more exposed silo to higher petrochems costs. In contrast, actually, INEOS Group, because it is already slightly more leveraged to US ethane than European naphtha, but also because of their Project One, which is going to be Europe's largest ethane cracker. I think it's 1.24 million tons of capacity. That's due to come on stream in 27, and that is basically designed to capture the cost advantage of North American ethane. So actually, the two silos within EOS are kind of moving in different directions. outside of INEOS, even big names like BASF, a very strong A- rated chemicals credit and the largest chems name in the world, but they are going to face certainly pressure in the pure petrochemicals part of their value chains. Now, of course, BASF has a lot of other parts of its business in order to offset those pressures, but that's just an example of the kinds of names that are going to be more pressured. But I think the pressure is going to be pinching most of Europe, as opposed to what Andrew has been talking about in the US.
Totally. And I feel like that's a perfect segue to bring in Peter and his perspective from the secondary markets. I'd like your description, Peter, of kind of what you do at LFI. If it moves, you're writing about it. So I'd be curious to hear about, kind of the challenges that we've seen in the chem space relative to the recent washout in software that obviously was hugely topical, probably still is, taking maybe a little bit of a backseat to current events in Iran. Is there really any comparison in what we're seeing in software? Is that kind of in a league of its own? Take us kind of through what you're seeing in the market and how those two things fit together, or perhaps do not.
Yeah, so last week I was at the JP Morgan Leverage Finance Conference in Miami, and I brought back some of that weather with me to the East Coast, but to New York. But chemicals and software were top of mind there, and so for a lot of investors, what they had said is that chemicals was actually one of their better performing sectors. And this coincided with the software sell-off. And one interesting thing that happened was, since January, we've seen portfolio managers, sell some of their software exposure. And they've spread this. They haven't been cash heavy. They've reinvested this cash and they've moved into cyclical sectors like chemicals. So basically, the challenges in both sectors, what investors have said is they're very different. In that with software, we don't know whether this product is going to be obsolete in 5 to 10 years' time, or whether a company will have a product. So investors cannot project what's going to happen 5 years down the line. Even though there's a 2028 maturity, companies may be able to refinance, but we don't know if this company is going to exist in 10 years. We'll always need chemicals. So, they've essentially, what investors have said is this cycle has lasted longer than others, but they can measure and make projections based off of assets, which software companies don't really have since they offer a product. They can't really sell off this product, while chemicals companies, they have whether it's property, other assets they can sell and offload. They've seen a lot of this messaging over the last 2 months be more positive. So we've seen companies come out and say, hey, we might sell off some assets. And investors see that as positive. The cycle's lasted longer than others. Obviously, we don't know how long this cycle will continue to last because there's a lot of variable factors, not just the war in Iran, but whether it's interest rates, whether it's economic outlook. This is still a huge factor, and it's going to play well into 2026 and 2027.
Yeah, there's a lot at play. I find it very interesting to hear about a rotation out of software into chemicals. I feel like certainly hearing Andy's comments from Europe sounds like a lot of structural challenges that are unlikely to fade anytime soon, regardless of a $500 billion infrastructure spending package, which doesn't sound like it's necessarily aimed toward chemicals, neither chemicals nor the near term. And so to think about rotating out of software, which is perhaps idiosyncratic for now in terms of being in the crosshairs of AI, but maybe there are other sectors to come, to think about moving into more cyclical names on the back of that. I think that's interesting. Maybe that's more of a relative value consideration and a more attractive entry point. Did you get any additional context on why chems? Was it more of a relative value consideration, or are there other things at play, or was chems just one place investors were going out of software, not into cash, but into other sectors as well?
Yeah, so we've seen investors are largely, whether it's software, moving out of software, they're going into general industrials, and they see that as kind of, whether The housing market might take a turn, even though that's not really the belief at the moment. But they're going into safer sectors that they believe can, weather a potential economic downturn. Even though the general consensus across the board is that if we start to see what kind of the doomsdayers have said of, hey, if there's a lot of white collar workers being unemployed because of AI, it's going to trickle down the entire economy, including the chemicals. But still, the rotation, this impact is going to take longer. Now, in terms of bringing refinancing opportunities and debt to the primary markets, it's very tough. If an issuer is trading in the 60s or 70s, it's very challenging to bring these deals to the primary markets. And so you're going to see a lot of this go into, whether it's restructuring an LME, even though the word LME is usually seen as negative, but sometimes it is needed. And so, we're seeing this but companies are coming out and talking to investors, and whether that's INEOS and others, they are saying, hey, we're talking to lenders. We're looking to sell assets. This is all in very positive compared to what we've seen in other sectors over the past few months. And, again, if you've been in chemicals for a long time, and this is what I was told, is that, well, you're eventually going to get paid on your investment. So even though there's all this distraction and distress, investors feel that, well, hey, they've kept their promises before. They assume that will be the same. I do see some messaging that is slightly concerning. And investors have highlighted that companies are like, well, we're addressing 2027 maturities. And this goes to INEOS, they're doing this now. And they're saying we are going to turn this around by the time 2029 gets here. Will that be the case? And so there's a lot of variables here when you're, is there actually something that we're seeing technical that's going to turn things around? But we don't really, it's tough. We're still at record levels for, primary activity, in terms of rates. So there are opportunities, and investors are willing to extend maturities for better protections. So it can be done. We have yet to see it, but usually in these situations, we often need the bigger player in the sector to come first, and then everyone else follows.
Andy Belton, can they turn it around? I know you kind of you kind of ran through a little bit of INEOS Group versus Quattro. What's your perspective? Kind of take us through a little bit more your response to Peter's question there. That's kind of out there for the market to weigh in on.
Yeah, it's interesting, to be honest, Zach. And I do take Peter's point, and INEOS is one of those names that over the last 6 months, I have had the most conversations with investors on, of course. And to be honest, investors are split. There are doomsayers. There are people who are absolute bears. There are people who are, to my view, maybe a little bit too bullish. And that I have heard the argument that we will always need chems, and at some point this downturn will turn itself around. And I'm sympathetic to that argument per se. The problem is, A, how much capacity will be taken out or needs to be taken out before that happens. And B, how many casualties we have, of course, because yes, we will always need chems, but the issue is, do we always need every single one of the chemicals credits, whether it be, the triple B names? We'll always need BASF. I think we can sort of park them in a sense. But whether or not some of these high yield names will still be around in 3 to 4 years' time, that's a different story. And with INEOS, the jury's out. I take Peter's point as well about INEOS has tried to address the 27 maturities. They've done a 300 million inventory monetization facility. They've increased slightly their securitization facility. We are told on the call last 10 days ago that there's going to be 200 million of new equity coming down from the owners of INEOS, i.e. Jim Radcliffe. I will write that when I see it myself. But there you go. I've been around in the credit markets 30 years, and I'm a born cynic, I would say. But they also have done a number of things. As Peter mentioned, they're talking about selling assets now. The investors were a little bit spooked when they started to say the scuttlebutt was that INEOS was going to be selling assets within Innovin. And the difficulty is once you're very firmly embedded in these value chains, it's very difficult to suddenly start selling PVC assets. Thankfully, during the call, INEOS said, no, what we're actually trying to do is we're going to be selling sort of non-EBITDA generating assets. So, for example, they mentioned anecdotally on the call that they have 200 residential properties in and around Antwerp, which is where they have obviously a plethora of facilities. That's where Project One's going to be built for INEOS Group, and that's where a number of the downstream operations of INEOS also have activities. So I can see what they're trying to do with the 27s. I think what's interesting has been the path of both INEOS Group and INEOS Quattro bonds since what's going on in the Middle East. Quattro was making a recovery, strong recovery, and there was a compression between the two names. That compression has widened back out again as investors are kind of saying, actually, one part of the silo, which I mentioned earlier, Zach, INEOS Group is better positioned, partly because they've already been trying to recalibrate their capacity towards ethane rather than to naphtha, but also because of Project One. Whereas the concern on Quattro is that they are downstream, they're reliant upon feedstocks, partly from INEOS Group, but they don't have as strong market positions as you would want. And there is concern amongst a number of investors about Quattro's ability to pass on higher input costs. So when feedstocks, as they are now, start to jump through the roof, the concern is what is going to happen to Quattro's ability to pass that on and maintain margins. And it's kind of like INEOS Group short-term pressure, but you can see not a silver bullet. To kind of anticipate a question that you might have had, the Project One is not a silver bullet, and it comes at a very high cost in terms of leverage. But it is basically designed to embed US feedstock economics into European production. So it's a strategic decision by INEOS Group to try and change their positioning and to catapult them into a cost-leading position and reduce their emissions. INEOS Quattro, I would say, is the one that I feel is much more exposed, and you can see that in this widening in bond prices now between Quattro and Group. So I think both of them are going to continue to generate very strong opinions on both the bull and the bear side. But my feeling is that I actually think that Group is better positioned, not just to navigate the current situation in the Middle East, but also actually to be positioned longer term as Europe's chemical sector continues to kind of restructure. Doesn't mean that I think both of them are good investments, but I think that INEOS Group is just slightly better positioned than Quattro.
More silver lining for INEOS Group versus silver bullet. Do you think that's a fair characterization?
But I will translate that into rel val views. I wouldn't be buyers of either silo at the moment, frankly, even at these prices. We are still doing some work. We have done, as you can imagine, quite a lot of recovery value work on both silos, particularly on Quattro. Those calculations, of course, are now basically in the bin. We've got to recalibrate everything and try and understand what the new situation in the Middle East is going to do. So the game has completely changed since 10 days ago. But nonetheless, I think, to be honest, and maybe it's my innate cautious nature, having been a long time ago a credit rating analyst on the other side of the Fitch Group, for me, neither of these two silos has enough momentum to warrant getting back in. I think there's still going to be an awful lot of volatility over the next however many months we're in for this volatility in the Middle East. And the safest position in those two particular names for me is on the sidelines, not pulling your hair out, worrying if you're going to lose next year's bonus.
I think that's certainly reasonable. Thank you for all that, Andy. I think that's really helpful and a lot for our listeners and clients to consider in terms of how to position portfolios or position within the sector. Andrew Brady, I want to go back to you. Obviously, we can't have a discussion on the chem space without addressing the Bayer-Monsanto case. I know you and our head of legal research, Mark Leitner, have done a great job covering this one. Can you kind of give us an update there and how that situation is affecting your assessment of litigation risk and the associated risk premium in the space a little more broadly?
Yeah, thank you. I think we've, Mark and I have done a lot of work on it, and Mark's really, really great working with it. And we've done a lot of litigation stories over the years, at CreditSights at predating it. And it's almost like Tolstoy, every litigation story is dysfunctional in its own specific way. And I think that that's a good analogy for Monsanto and Bayer. So in December, the Solicitor General um, recommended that the Supreme Court take the case, the glyphosate case, and they agreed to take it back in January. They will have hearings in April around that we will listen to and try to get a feel for how they might decide the case. And then we should hear a decision in late June. It might fall into July. We'll see how it goes. So yeah, you have that kind of side of it going on. And then the big news, I suppose, is the settlement. And we were a bit surprised that they were able to get a settlement going ahead of it. We thought that they would just go to the Supreme Court, but the move itself was pretty shrewd, in our view. Is you basically created this place where now you're putting the decision of the litigants in to whether you want to roll the dice on what the Supreme Court's going to do, and it's 6-3 conservative. So we're looking at it like, hey, you got 3-3, and then the winner is going to get two, for the other one, and then then you would have your five. You have to get at least two, so two of the three, and then so from my perspective, litigants are looking at a less than 50% chance of getting paid on that side. And then you have the option of taking the money and taking the settlement, and then at least having what a burnt hand, two in the bush kind of analogy there. And I think that is a highly incentivizing, leveraging way to get people to go into that. Now, whether or not that setup in a settlement is legal is still yet to be determined, and there's a fairness hearing and things like that. But the litigants have to decide by June 4th whether or not they're in or out. So I think it's going to be really hard for litigants to say, you know what, I think I'm going to roll the dice. I think I'm going to go after it, and we'll see where it goes. So I think more than likely, that route is going to end up in zero money. And then we'll have to see whether or not it's legal. I know that Mark is doing his work on it, and we'll have more fuller discussion points as to some of the issues there. And I don't know if 100% everything is going to kind of go through. So there's that little bit of a wrinkle there, and I guess that gets back to just dysfunctional in its own specific way. Like there's a lot of little things, there's a lot of ways to do it. Each litigation situation is different, and this one is fairly complex. And but I think it's near in the end. I guess is a good way to say it.
Yeah, there's a lot to consider there. What are some of the most prominent client questions you're getting on the name at this point, and kind of how are you positioning? I mean, I see you have an outperform on Bayer. Maybe take us through some of the key factors driving that, and what you're discussing most with clients these days before we wrap up here.
Yeah, I think the biggest question we get from clients is, I think at this point is, how the justices might look at this. What are the factors involved? What are the key trigger dates? Things like that. Is the settlement possible? How do you speak for, I guess, future claimants? I think is really the big one. You also have this we didn't really touch on it. This Trump administration came through and said glyphosate will be a defense, exemption. What kind of immunity do they get from that? Is it blanket? Is it not blanket? How do you consider that? What does that mean for future claimants? So a lot of discussion. Lots of discussion on future claimants and how the Trump signing fits into that. And then when you get to the other side of it, okay, so say they do get it, they're also putting a lot of debt on. They're going to do, said equity, they're going to do equity, and now it's, quote unquote equity like. which is the hybrids, which, I don't know how they're equity, but, or like equity, they're definitely junior and they're definitely below you. So I guess that's positive. So anything below you, I guess, is equity. You can kind of like that. So it's like, okay, there's a lot more debt on it. It's junior and stuff like that. Is it positive versus negative? How do you kind of sort through all that? I think, I think people are coming down on the side. It's, neutral, neutral. Someone on the neutral is slightly negative. We're on the neutral is slightly positive. And then, okay, what are they going to do? Do they have the resources and the ability to invest in this pharma business? Are they going to consider spinning it again? If they did, how would they do it? How would it kind of go? And I don't think Bayer itself wants to inject those kind of discussions into the story right now. I think they want to get past the litigation and try to figure out what exactly is the situation on the other side. But I think those issues are going to start cropping up again.
I feel like we have a differentiated view, which is always great and helpful for our clients to be thinking about some of these major situations and themes through a little bit of a different lens than perhaps what the market consensus is. And I feel like that's similar to sort of how we've been positioned from a strategy perspective coming into this year, with a little bit more of a risk off tone, where I feel like the general consensus has been quite risk positive, and there's a lot of factors at play with it, whether it be within the chem space or broadly, that seem to be you know a little bit underpriced in various parts of the market and overpriced in others. So certainly great to have that perspective and all of your experience on that. So thank you all for joining the podcast. Andrew Brady, our head of US Basics, Andy Belton, head of Euro Basics, and Peter Agra, managing editor for secondary markets at LFI. Thank you so much for coming on the podcast.
Thank you.
Thank you all for tuning in. We'll catch you next time on No More Risk Better. Good luck out there.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.